The information in this podcast is general information and not advice. Stanford Financial is authorised under Australian Credit Licence Number 541480. Further information is available at stanfordfinancial.net.
Hello and welcome to On the Couch with Steve, a podcast where we help you navigate the often complex world of buying, selling and renting real estate. I'm Steve Athanates. I'm the owner of NG Real Estate here in Ipswich. I'm joined today by Steve Beach from Stanford Financial. So thanks and welcome, Steve. How are you today?
I'm good, thanks, Steve. Great to be
No
here.
worries, mate. Now, you're a return guest. Now, the reason you're returning, we're going to talk about interest rates, which is scary in itself for most people. And just not interest rates themselves, but what's going to happen into the future. What sort of things are happening for first homeowners, how people are trying to create cash flow moving forward as interest rates are rising. So what sort of things can be done? So big podcast ahead today, mate. Really important one. So really appreciate you taking the time. So without any further ado, mate, what's going to happen with interest rates?
Okay, so I guess with interest rates, we've seen, 10 interest rate rises consecutively, which has hurt a lot of people. I know in previous podcasts we've talked about people coming off fixed rates, where they're seeing interest rates of around 2% now coming into the market into the 5s or potentially even into the 6s. With recent happenings with the Silicon Valley Bank sort of going into receivership over in the States, we have seen a little bit of a ripple effect through that. I don't think it's going to be worldwide. There's been a lot of sort of control by the American government in protecting a lot of people with that. But with that going ahead, I foresee that most economists are now probably predicting here in Australia that potentially we're not going to see the one or two more interest rate rises that they're all sort of talking about. I think we might see Phil Lowe actually slow down the rate rises and probably put it on hold for the next 6 to 12 months.
Okay, so hang on a sec. Let's get this straight. We've seen some banks in the US go bust. Okay, we were predicting potentially up to 2 more interest rate rises. You're now thinking maybe not, and we may actually stop.
That's correct, yep. So I guess primarily we were reading a lot of articles with NAB and Westpac and CBA with their predictions of, everyone was pretty much still predicting an interest rate rise in April. Nowadays with, the curving of inflation, unemployment is still going down. So there was about 45 to 60,000 jobs that was taken up in the last quarter is what's sort of being predicted at this stage. If it's on the higher end, then they may be enforced to raise rates again. If it's on the lower end, they'll probably potentially, and fingers crossed for everybody out there, including myself, is to stabilise and hold interest rates. I think they should probably look at seeing what's actually going to happen, like with the cost of just milk, bread, and particularly fuel. All this is continually going up. Cost of living keeps going up. And if they keep pushing interest rates up to ultimately stem that inflation, I think we're seeing at the moment, particularly talking with a lot of our clients, is it's done what it's needed to do. And I think we should start to see sort of a break in rate rises. Not saying that rates are going to go down anytime soon. I still am in the, mindset of what a lot of people are saying, is that we'll probably start to see a couple of rate reductions early into next year. And then again, further into 2025 is where, mid-2025 is where they expect inflation to reach the 3% threshold, which is what the RBA would like to see. So in doing so, they've done what they needed to do, so what goes up must come down. So we will see that peak, and I think we're pretty much at that peak of where inflation and rates will peak at.
Okay, so we've got some good news, everyone out there who's listening and watching this podcast today. So here we are, mid-March. Okay, hopefully we've reached the peak. Hopefully we've seen the end of rate rises. They're certainly not going to go down just yet, but hopefully they're stabilising. So that maybe some of the pain that people are feeling in their back pocket may come to an end in terms of increases. So hopefully that's great. Now, for someone who is going to pop out, and we've got a lot of people who are due to pop out of fixed term rates, for a lot of those people, it's scary. They could jump out from sub 2% and pop out anywhere between 6 and in some cases 7%. That's correct?
That's correct.
Yep. So for those people, what can they do before they pop out to try and help with their cash flow? Because for a lot of these people, it could be diabolical.
Yeah, no, true that. I guess the biggest thing that we're seeing right at the moment, because there are a lot of people that have already come off these 2% rates, because they started in ultimately the start of COVID, sort of April, May 2020. A lot of people fixed for 2 or 3 or 4 years, or have only just got into the marketplace, sort of early last year or the year before. So what we're seeing a lot of people doing at the moment is in regards to refinancing their home, is to consolidate existing debt. So to try and essentially build that equity that they've had in their property over the last sort of 12 months or 2 years, to then add the car loan and some credit card debt back into their home loan, which you might think that's a bit crazy. Rates are going up, you're going to borrow more money, but essentially you're freeing up cash flow, whereas a standard mortgage might be $2,000 to $2,500 per month. After the rate rise, it might roll up to $3,000, but you may still be paying $500-$600 for a car loan. You're paying $200-$300 for 2 credit cards. All of a sudden, your total exposure on all your loans is about $4,000. By refinancing, even at the higher rate, it'll still be less than what you actually were paying on your car loan and your credit cards and stuff like that. Now, I'm not a financial advisor, can't tell you what the best, but that can free up some cash flow. So it's best to probably talk to your broker to have a chat about what steps you can do to essentially protect yourself with the upcoming cash flow crisis.
Okay, so great point. Now, we're not financial advisors, so it's very important we stipulate that. So for the people who don't need to incorporate car loans and credit cards, but someone who potentially wants to still save some money,
yep,
can they go to their existing lender and say, hey, I was sub 2% or 3%, wherever you locked in, I know rates are 7% or up to 7%. What sort of a deal can you do for me? Or should they look at refinancing now?
Yeah, I guess a couple of things with that would be so once your fixed rate does expire, most banks will just roll your loan into a standard variable or a basic variable rate, which without any sort of pricing by the bank or talking to your broker, we're seeing people come off interest rates at almost 7%, like you sort of said, whereas we then get in contact with them saying, hey, no, you shouldn't be at that rate. Let us do some pricing with your bank, and we're getting them back into the early 5s. So we can save sort of 1.5% just by sending an email to the bank saying, hey, we want our client to be better off, and these are sort of the rates that they should be getting. Alternatively, if your bank isn't forthcoming in regards to giving you those sort of interest rates, we've been doing a lot of refinancing and utilizing that equity, because a lot of people came into the market where they only had a 10% deposit. Now they've built some equity over the last couple of years. They've now got more than sort of 20 or even 30% equity in their property, which means you're now in a different, what we call as LVR tier or bracket, which means you can get much better rates, particularly if you're not in that more than 20% or less than 20% deposit sort of equity position.
Okay, so there's something really important for you people watching and listening. Okay, ask the bank for a better rate first and foremost. So ask, and hopefully you shall receive. Now, if you don't receive, don't be afraid to talk to other banks. You can obviously talk to a broker in relation to it. Brokers obviously have access to all of the institutions, as opposed to if you're with the Commonwealth Bank and you go to the Commonwealth Bank and the Commonwealth Bank says, no, you're getting 7%, too bad, so sad. You go to a broker and say, okay, take me to everyone and get me the best deal.
That's exactly right. And that's what the brokers do, is we do have what they call as best interest duty. So we must shop around for our clients to get them the best possible deal and the best possible rate. That's available.
I like that. I like that you are duty bound to find them the best deal for them.
That's it.
Awesome. Great to know. Now, obviously, rents are gone through the roof. Poor renters. We all feel sorry for people who are renting. What's happening to people who were renting and the rents are now so expensive? Are we seeing like an increase of first homeowners becoming buyers? Renters who are now becoming a first home buyer instead of renting?
Yeah, so we've definitely seen an influx of clients calling up and saying, hey, what can I do? I've been told it's best to talk to a broker just to start the process to see what, I guess, options are available. There are still first home loan deposit schemes where you only need the basic 5% deposit to be able to buy a home, and the government will still back the other 15% to get you those better rates and better deals to get into the marketplace. So particularly for first home buyers. The second one we're seeing a lot of at the moment is parental guarantees, where mum and dad want to help their kids out to get them a property. So they've got a mortgage over their house. We can then put a second mortgage over their house by utilising, therefore, the kids actually need no deposit to buy a house. We're doing quite a lot of those at the moment. The other big one, and particularly in I guess our area in Ipswich, we're local RAF base, so we facilitate a lot of DOAS loans as well, which is the Defence Home Ownership Assistance Scheme, where the DVA or the government will actually help pay back a portion of existing or previous members' mortgage repayments. So,
well, look, and that's important to remember. We are here in Ipswich. We're a proud military community. Love the RAF base and all the serving personnel. So great that there's a special deal available to those serving personnel. I guess the good news for renters is they do have some options.
Definitely.
Through government subsidy, or if they have parents who have built up equity to potentially be able to help them into a property so they can get away from that rental rat race.
Definitely.
Awesome. Well, mate, look, I've got to finish off with, what is your prediction? We are, halfway through March 2023. Big year, I guess, coming up in terms of still a lot of uncertainty. Banks going broke, which we haven't seen for a long time.
No.
Was the last time? When was that? 2008?
2008, yeah.
So we haven't seen a financial institution go broke since 2008, yet we've seen 3 go broke in the last 4 days or something like that. What's going to happen for the rest of this year?
Yeah, again, my magic crystal ball. I left that at home.
Oh, that crystal ball thing. Oh, it's cursing me, that crystal ball.
I guess moving forward, again, my only interpretation of it all is as I mentioned earlier in the podcast, is my prediction up until probably last week was definitely another rate rise and possibly another one, probably after the end of financial year sales, because I reckon there'll be a lot of people utilise their tax money and they spend in that June period. So we're also expecting probably another rate rise in sort of July, August. I think that's probably off the cards now. Whether or not I guess this impact now has had enough of an effect for the RBA not to lift rates in April, probably too early to be sure on that one, but good chance that there are now a lot of people predicting just in the last day or two that rates will be put on hold. Most economists and pretty much all the major banks, they release this every month, or particularly quarterly, is their predictions of where the cash rate will be in Australia. And pretty much every single bank have predicted rate reductions in 2024 and rate cuts in 2025. So we're probably seeing that the interest rates will actually get lower than where they were late last year.
Okay, boom, you heard that first on the couch with Steve. So some real hope, and I guess some optimism about future markets in terms of interest rates and obviously conditions for people. Remembering these are things that affect people's day-to-day ability to live. If everything just keeps on getting dearer, it's not a bottomless well that you can just keep reaching into and pulling out money. So I think there's some real hope and positivity there for people who are current homeowners, people who want to be homeowners into the future, and obviously even people who are renters who are aspiring to get out of that rental market, because, let's face it, it's real tough there. It's real tough. Mate, look, guys at home, thanks for tuning in to hear and see more of On the Couch with Steve. Make sure you subscribe below. We'd love to hear from you. Special thanks, Steve Beach from Stanford Financial, mate. What you've just told us, unbelievable. Great insights for me as an experienced and dominant real estate agent. For mums and dads and the punters at home, invaluable. So thank you so much. Really great.
Absolute pleasure.
No worries, mate. Look, now, if you have an opinion, and I'm sure lots of people out there will, about what we've discussed today, please share your thoughts on our socials and stay tuned for more on the Couch with Steve. We'll see you soon.